Financial Minds. I'm Jaime Agostino, your host. Today we are joined by our Vizzo financial economic gurus, Tim Sustak, our SVP Chief Treasury Officer, and Scott Wood, SVP Chief Investment Officer with Vizzo Financial. The Federal Reserve meeting is next week. What will the Fed do next, and what impact will it have for credit unions? Let's find out. Tim, I'm going to start with you. So, what are the top economic indicators the Federal Reserve is watching most closely right now?
Well, there's all kind of interesting stuff to watch out there, Jamie, right now, as you know. Um, but I think, in general, as we kind of always say, I mean, they watch everything, but the big things, right? As you would expect, the dual mandate, employment and inflation. And we just got a new jobs report this morning. We were talking here a little bit beforehand. As Scott said, it wasn't too pretty. Payrolls fell by 92,000. I think the estimate was somewhere around an increase of 50, if I remember that correctly. Scott, correct me if I'm wrong, if you see it out there. But, you know, there's a couple things, I guess, to unpack on that. Um, you didn't have the best weather in January or February. There was a major healthcare layoff, and those jobs had been kind of stoking the employment report. So, it's one report. It's certainly not what we wanted to see, a drop, and there was some revisions downward for the past few months, not as notable as the drop for this month, but they'll certainly be watching that to see how that trend goes. One employment report doesn't make a trend, but it's not what everyone expected, that's for sure. So we'll see where that goes. And then, on the inflation front, the Fed watching the PCE, that had been stable the past few months, bumped up a little bit in December to 3%. So they'll be watching that. And then certainly with, all that's going on in the world right now, the Iran conflict that we're in, oil has bumped up to what I think the latest I saw was around 90 a barrel. Um, yeah, benchmark Brent crude broke above $90 a barrel today. So that's going to serve to work on inflation numbers as well. So hard to say where that's going to go. We're talking about, escorting tankers through the Strait of Hormuz. So that, that pinch point isn't there. But I think all that kind of remains to be seen and how that's going to affect oil over the longer haul. And then, what the inflation numbers will be as well. So a lot to watch. But I think in general, inflation and employment numbers is where the Fed will start.
All right, thank you. So, Scott, I'm going to go to you next, and I'm going to give you a little bit of a challenge. If you had to summarize the current state of the U.S. economy in 1 to 2 sentences, what would you say?
Yeah, it's I'd say lots of uncertainty, and really you could make the case that we're going to have a positive economy this year, strong economy, or that we might have a recession this year. I think there's data pointing in both directions. So it's I think on the last call I said that I was hopefully optimistic.
Yes.
And maybe my view is starting to change a little bit because there's been a lot of not so positive development since then, I guess. And one that Tim pointed out today, it's 1 month, but the jobs report today or that came out here was not super attractive, to put it nicely. No, as Tim pointed out, there were some issues with it, weather being one, healthcare jobs, there was no hiring in healthcare. So there were some issues. So we'll see if the trend continues, but it was not a very attractive job report. And there's some talk that, how much of this is AI that's causing some companies to actually go through with layoffs because we can take up some of the slack with AI. And I think, from the discussions we have with credit unions, the articles I read and the things I hear when I'm on webinars and things, it makes me think that there could be some truth to that AI may be starting to have some impact, helping with productivity. Another part of it is, we hear these stories that companies overhired during the COVID years because, it was hard to get people. So they overhired, overstaffed, and that maybe they're kind of trimming some of that fat now too. So it may not even be AI related, but it may be. There may be some of that's. I tend to think that some of that is AI related. Um, but if you think about that, if it is AI related things and it's stronger productivity, that's a positive for the economy from a GDP perspective, right? um, it should be good, but obviously it's a negative for if it impacts people and employment and jobs, and that's something that would have to be addressed if it becomes an issue. Again, we're going to want to see what March employment looks like in April and continue on, but this month was not super attractive. We obviously have the Iran. I don't know if we want to call it a war or a conflict or what the technical term for that is today, but that's a major wild card. Tim pointed out the price of oil. Oil obviously is an inflationary measure. We tend to look at core that excludes that, but certainly when we talk about inflation, gasoline prices are one of the biggest things that every one of us sees, unless we have all electric vehicles, that we see on a regular basis. We're going to the pump, once a week or maybe more than that as we're traveling. So psychologically, it's a pretty immediate, right, when we see those prices go up at the pump. So we see those, and the oil is an input, obviously, to a lot of other things. So we've seen the positive trend of inflation come down, but we could certainly see a reversal here if this conflict goes on, and there's other disruptions that could occur because of that. Inflation had been coming down positive. GDP growth in the fourth quarter was weaker than expected. We had the government shutdown, remember, so we anticipated a weaker fourth quarter after a really strong third GDP. The fourth quarter was weaker than expected. We'll have to see what the first quarter looks like, hoping it'll be strong. We still have income tax returns that we've heard are going to be higher than anticipated. Net positive for consumers, more money in their pockets. Do they spend it right away? Do they pay off debt? Do they hold on? Who knows? But bottom line, if there's more money in our pockets, that's a positive thing for the economy. So a lot of uncertainty, and even surrounding the two things that the Fed's been really focused on as part of their dual mandate, inflation and maximizing employment. We have this war, conflict, whatever you want to call it. So if it does drag on in Iran, that could create some big issues in the marketplace. It'll certainly distort the markets. For those of us that are invested in the markets, we've seen some pretty ugly down days here with equities. So yeah, uncertainty. I want to say hopefully optimistic, maybe not as optimistic as I was last month when we did this, but I'm still hopeful. I'm still hopeful that things will materialize positively this year. I think there's a lot of good things out there that should keep things moving along and strong.
All right. So Scott, with your feeling of uncertainty, what do you expect the Fed to do at the next meeting?
Yeah, they won't do anything. I don't anticipate at this next meeting. At their last meeting, they kind of told us it was less of a pause and more of a stopping. Like we're going to hold off for a little while. We're going to look at they want to give the data time to come in and keep an eye on it for a little while. Unemployment rate had dropped to 4.3% at the last reading. It's back up to 4.4% of this month. So, from February data. So not horrible. When you look at the unemployment rate, it's still in that, natural rate of unemployment is in that range.
Mm-hmm.
So not a bad thing. They're going to keep an eye on that. So they won't do anything at this meeting. When you actually look at Fed fund futures, the markets don't think the Fed is going to do anything with 100% certainty till their September meeting. The odds are, in the 90 percentile at the July meeting that the Fed may cut 25 basis points. And remember, by then too, we should have a new Fed chair, assuming they make it through the gauntlet of the Senate and confirmation and everything goes well. I haven't heard anything. Well, there was a threat about from Senator Tillis here in North Carolina, where I reside, talking about he will delay a vote on the new Fed chair, if this investigation into Chair Powell proceeds, if it's not dropped by then. So we'll see if he holds true to that, and if that happens. But I anticipate we'll have a new Fed chair on schedule, as we all anticipate. I don't anticipate any major issues getting that in place. And of course, that could change the trajectory of the FOMC. But with that said, the FOMC is very split right now. It's versus hawks and doves, those that would hold rates where they're at, potentially raise them versus those that would like to see cuts. It's pretty evenly split. And I would say it actually leans a little more to the hawks this year, those that would rather see no cuts and potentially hikes compared to what it was last year. And add in a new Fed chair won't really change that equation, right? So if the Fed's truly looking at the data, which we believe they are, right, that they're focused on the markets, then the data will have to deteriorate, more for a Fed to cut. So if we see continued unemployment or the employment numbers continue to drop, if jobs are not being created and maybe the unemployment continues to tick up, then that will certainly increase the odds of a rate cut, whether it's Powell or somebody else as the FOMC chair. So nothing at the next meeting. Maybe, again, if we keep an eye on the data, but maybe something by mid-year or September as the markets think.
Okay. Tim, when we talk, we do focus a lot on employment. So how does the strength of employment affect the Fed with their decision making? What are they looking for?
Yeah, I mean, it affects their decision making a lot, right? It's part of that dual mandate. And, if you listen to Chair Powell talking over the past few press conferences, he talked about the fact, the concern was that, hey, employment is faltering, right? And those that were kind of lobbying for faster rate cuts, that was the argument that they used is, hey, unemployment is weaker than you think. We're going to start seeing that we need to act. And, the other side of the coin was, well, yeah, unemployment is weakening, but it's weakening in a controlled fashion, right? It's not falling off the cliff. Jobs are not being created as at fast a pace as we had seen, but there's less in the workforce through reductions in immigration, things like that. So, the talk was, hey, yeah, job market is cooling, but it's cooling in a very controlled fashion, which I think the Fed was comfortable with. And, like Scott said, kind of gave them the ability to say, look, we can take a pause here, wait for more data. As Scott mentioned, the Fed is very split. And I think it's because, yeah, inflation's a little higher than what you'd like to see, but it's, not ripping forward, certainly. It's, kind of just fluctuating around a range. And although unemployment has risen a bit, job creation has fallen off a bit, it's controlled. So, everybody was pretty comfortable. I think waiting for more data, with this kind of employment report, and like we said, it's one report. But I think, particularly the doves out there will certainly be looking to see what happens from here on out with unemployment. And the argument will be made that you certainly don't want to let a fall off in employment numbers, get ahead of you. So it'll be an important point going forward, as it always is. And we'll see if this report is just kind of an aberration based on those couple things we mentioned, or whether it's, the start of something bigger.
Okay. Scott, you mentioned the markets earlier. What does the current yield curve tell us about where the market thinks the economy is headed?
Yeah, I mean, excuse me, right now the front end of the curve, very short front end of the curve is slightly inverted. And then the rest of the curve, if you look at it, if you kind of took that part away, the curve is what I would consider normal shaped. It's got normal shaped yield curve. And normally we see a normal shaped yield curve when the markets are comfortable with what's going on economically, that, the economy is going to plug along, do well, and things are, they expect things to be pretty well. Not saying they're going to be screaming hot, not saying, they're just going to be fine. And that's kind of what we have for most of the curve. On the short end, obviously, we have a little bit of an inversion there. So that kind of indicates that the markets think the Fed will, kind of built in on that with that curve there, that the Fed's going to cut one or two more times. But they think that the economy is doing well, going to continue to do well the way it is now. Now, there is some uncertainty built into the market here in the last few days, especially because of the war we mentioned, or this, what's going on in Iran. So we've seen yields bump a little bit higher. There is some uncertainty there. There's also some concern with the level of debt that we carry in this country, that it's such a large part of our GDP and it's such a large part of our outlays every year is interest on this debt. So there's a lot of concern by that. That's kind of keeping the longer end too a little bit higher. But overall, we have a relatively positively normal shaped yield curve, which is indicating that the markets are not overly concerned right now with what's going on in the economy. So, and I tend to, feel the same. I feel like things overall look pretty good. Agree with the yield curve. Or what the markets are telling us, but obviously, as we mentioned, there is some uncertainty here. But the good thing is, we don't have this, negative least slope yield curve where the markets are projecting a recession coming up or anything like that. So what it's telling us today is the markets don't really think there's a likelihood of a recession. It's pretty slim. They think the Fed probably needs to cut one or two more times. That would get the yield curve completely normalized if they were to do that, and it stays kind of the way it is. So so far, nothing negative, really, no negative sentiment from the shape of the curve.
Okay. Tim, you've kind of been sitting in that camp of uncertainty for a while now. I think, last time we met, Scott was in the hopefully optimistic kind of side, but you were still kind of in the uncertainty. So, kind of channeling that, what economic indicators are you going to be watching closely over the next several months?
Yeah, well, you heard Scott to start. He went from the camp of feeling pretty good to uncertainty again. So yeah, I mean it's hard to say anything but right given all that's going on. I think the thing I'm going to be watching most closely, I think, is the unemployment side of things and where this goes. Only because I think both PCE and PCE core just ticked up just a bit in December, but there's going to be a lot of noise in there with, what's going on in Iran and where the price of oil will go. And I think, that's going to be another one of those things that you think it is certainly going to affect pocketbooks in the near term, but it should work its way through, right, as this, process progresses. The employment side is interesting, especially because we did have that jolt here this morning, and I'll be interested to see if that continues or not, because I think that, as Scott said, very divided. I think the Fed was planning on sitting here and waiting, obviously. And if employment starts to fall off more, there's going to be a bigger argument to, want to maybe make a correction for that. And with the new Fed chair coming in, kind of, a bit predisposed on the rate reduction side, I'll just be interested to see how that plays out, because I think that's going to be state the obvious, a big factor in what happens. And it could, like Scott said, the markets are not, expecting a rate cut until summer. Those bets have kind of backed off a little bit on the number, but if we continue to get employment reports that are lackluster, that could speed that up a little bit. So we'll see. I don't know. I still think this is kind of a point in time, a few things affecting it, but this will be interesting to watch.
All right. Well, I promise that until we have a new Fed chair that I keep asking, is there any news on who's going to be the next Federal Reserve chair? Do we have front runners? Scott, what's going on with the chair?
Yeah, so we do have an official nomination. Kevin Warsh was nominated by the president. It was a longer process. Tim and I talked about this on prior calls. We thought we were going to have a nominee last year, because they had thrown out there a few names, and they told us that they were going to do it pretty soon. So the markets were looking for it late last year, November, December. Then we got into this year, and we're like, okay, when's it going to happen? Early January. So we still hadn't heard anything. There was still a list. Trump was interviewing folks and talking to the potential candidates. But yeah, Kevin Warsh is the guy he's going with. He's nominating. Like I said, I don't anticipate him not being the Fed chair. The markets like him. I think he'll be fine getting through the Senate. Aside from what I mentioned earlier with Tom Tillis threatening to hold up the nomination if this investigation in Chair Powell is not resolved, dropped or whatever you want to call it. So that's a potential hiccup. I don't think that's going to be a major thing. So we'll probably have Kevin Warsh sometime in May. He'll go through the confirmation hearings, become the next Fed chair. And then the thinking is that well, another thing here I'll throw out there is we still don't know for sure if current Chair Powell is going to exit the FOMC when his term as Fed chair ends in May. He still has, I believe, almost 2 years that he could stay on the FOMC board if he wants to as a voting member. And that could certainly gum up the works for maybe more rate cuts. And that's what the markets think with Warsh being nominated, that when he comes into that position, that he may push for more rate cuts. And if he uses this automation, this AI thing and more, efficiency in the workplace, more productivity, then potentially that would be the avenue to cut rates, further, jobs being harmed and things like that. But as Tim pointed out, we have this inflation issue that's a little bit concerning. We're not at the Fed's 2%, 2.0% target. We are in the 2.8 or 9% range. We're kind of down slightly higher in one reading. A bit of a concern there, right, with inflation. As I mentioned too, the Gulf War, or I said the Gulf War, the war that's occurring over in the Gulf right now with Iran. Oil prices higher, certainly going to impact inflation. So it goes back to the Fed's dual mandate. They're already evenly split. There's a group that's heavily focused on inflation, another group that's more focused on employment. If these two are fighting each other, what does the FOMC do? It's hard to know right now when they're evenly split. It just means to me that they're going to sit there and give it a little more time unless one of those two clearly says, hey, we're flashing warnings here. But it will make Kevin Warsh's job more difficult, I think, come May or June, because unless somehow if the Iran thing is resolved by then certainly it gives him a clearer path to be pushing maybe for rate cuts. But if we're still having conflict over there, then that's going to make it a lot more challenging for him as a new Fed chair to get an already split group to agree on one direction to go in. It's time to cut rates, or it's time to maybe raise them if inflation goes higher, which I don't know if that's in the cards right now. It's more of a cut or hold kind of thing. It looks like, sit tight for a little bit. So Kevin Warsh should be there soon, and he has prior experience too on the FOMC board. So he's, like I said, well accepted candidate by the street. The markets like him.
Okay. All right. Thank you both. Any final thoughts for our listeners today?
I think, just as Scott was talking about, don't be married to any one outcome when you're kind of looking at your balance sheet and modeling out what happens and kind of planning. You just heard Scott talk about, how it could really go either way, right? I mean, yeah, the rate hikes aren't necessarily in the cards, we think, but, as Scott talked about, there's two groups at the Fed, rates going up was something talked about, so I would just say it's, with everything going on out there, it's, it's as uncertain as it gets, I guess. So don't be married to one outlook, take a look at how either, side of the rate move could affect your balance sheet.
Yeah, totally agree with Tim. A lot of uncertainty, which really amplifies the Fed's sitting tight right now, right? It's really hard to digest the data, what's more relevant right now. So it really speaks to what they're doing, sitting there for now, skipping in March to see what happens. So really, inflation could become a story if things drag on, as I mentioned in Iran. But I'm with Tim. I think the important one right now is really the employment. Keep an eye on employment. Does the February data? We had better than expected January. February was much worse than expected for the employment situation. So keep an eye on them. I would really focus on employment over the next, 2 or 3 months to get a flavor for where the Fed might be headed and what they might do. Could they potentially cut rates earlier than anticipated, maybe in May, or do they extend it out further? If the employment situation looks better again in March, then maybe the Fed, it could buy the Fed more time to sit there tightly. So I think that's probably the key indicator right now to keep an eye on is probably employment and to see where we go from here.
All right. Thank you both for joining me today. And you heard it, we are still in a point of uncertainty. So don't forget to subscribe, share your thoughts, and stay tuned for Vizzo Financial's post-Fed meeting analysis with Tim's FOMC update. Special thanks to Vizzo Financial's Financial Strategies workshops for sponsoring today's episode. Join any of these one-day workshops to enhance your knowledge through expert insights, engaging discussion, and practical strategy. With sessions on evolving economy, ALM modeling in a changing rate environment, historic lessons to guide your future investments, and loan pricing that encourages growth, you'll gain useful information to shape your financial strategy in 2026. Learn, network, and empower your teams to make informed strategic decisions that position your credit union for sustainable financial performance, no matter what lies ahead. Register today at www.vfccu.org. Next week, we'll be returning to our series on meeting the various teams at Vizzo Financial that are accelerating credit union success. As always, thanks for listening and make it a great day.